In July, $1 trillion fell out of semiconductor stocks: Nvidia, AMD, Samsung, SK Hynix. The companies that make the chips AI runs on sold off so hard the Nasdaq flirted with a correction, and every headline reached the same verdict: the AI bubble is finally bursting. Except, the same month, the four companies that buy most of those chips, Microsoft, Amazon, Google, Meta, told investors they will spend more next year than any four companies have ever spent on anything: $725 billion. Both of those things are true at once. And that is the story the crash headlines missed. The AI trade didn't die this summer. It moved. In the next 8 minutes, where it went, why Wall Street called it a rotation 3 weeks before your feed called it a crash, and why part of the bill lands on an account you never think about: your power bill. If you own an index fund, you own both sides of this trade. Let's follow the money. Rewind the month, because the order of events is the whole story. July 6, Morgan Stanley's chief U.S. equity strategist publishes a note: chip momentum is fading, prefer the hyperscalers, the giant cloud builders. Almost nobody outside Wall Street notices. July 8, the sell-off is on. Intel alone is down 21%. July 28, something snaps in the data: chip stocks and their own biggest customers stop moving together, for the first time on record. And by July 29, more than $1 trillion is gone from chip stocks worldwide. Korea's market is in a full panic, and your feed finally gets the story, packaged as a crash. 1 month. The professionals wrote rotation on day 1. The headlines wrote crash on day 29. Same event, 2 words, and the gap between those words is where this episode lives. So what did that July 6th note actually say? Not AI is over. The opposite. It said the money is real, but the winner is changing. For 3 years, the way to own AI was to own the companies selling the shovels, the chipmakers. The note said that trade is exhausted for now, and pointed at the companies writing the checks instead: the hyperscalers, who raise the capital, own the data centers, and rent the intelligence out by the hour. It even named names: Microsoft, Amazon, Meta. Now, we don't do buy or sell here. That call belongs to Morgan Stanley. It is a month old, and it may age badly. What we can do is test the mechanism underneath it. Is the AI money really changing lanes? That is measurable. 2 measurements, in fact. Here's the first. Measurement 1. The divorce. For 4.5 years, chip stocks and hyperscaler stocks moved as one trade. When Microsoft rose, Nvidia rose. Correlation, plus 0.78. About as married as 2 groups of stocks can be. In late July, that number went to 0. No relationship at all. The lowest reading in 4.5 years. Then it kept falling. By month end, Wells Fargo measured it at minus 31%, an all-time low. Chip stocks now trade opposite their own biggest customers. On days investors buy the cloud's future, they sell the chipmakers. And buried in the same report, the tell: semiconductors have started trading in line with capital goods, the boring machinery makers. The market has quietly refiled the chip industry, out of limitless future, into cyclical supplier. That is what a rotation looks like in raw data. Not a crash, a changed mind. Measurement 2. Follow $1 of that $725 billion, because they buy chips is barely half the story. Roughly 60 cents of every hyperscaler capex dollar goes to compute, the GPUs, and the servers wrapped around them. That is the crowded slice, the aisle July crushed. About 25 cents goes to construction, land, concrete, steel, the builders and the data center landlords. And the last 15 cents buys the unglamorous plumbing, networking, cooling, which alone runs 15 to 20% of a build's cost, and long-term power contracts. Now do the arithmetic the crash headlines skipped? At next year's planned spending, the boring 40 cents comes to roughly $290 billion a year, flowing to construction firms, cooling specialists, grid equipment makers and utilities. A second AI industry, hiding inside the first one, and July's sell-off barely touched it. And put the spending itself on a chart, because this is the part the word bubble hides from you. 2025, actual, audited money out the door, $410 billion from the Big Four. 2026, the plans they raised in their late July earnings reports, $725 billion, up 77% in a single year. And the street now expects the run rate to reach $1.2 trillion, Bank of America says within 12 months, Morgan Stanley says by 2027. Those last 2 bars are plans and forecasts, not receipts. The chart flags them, but the direction is not subtle. For scale, that last bar is roughly the GDP of the Netherlands, spent every year, by 4 companies, on server halls. You can call that visionary, or terrifying. The one thing the chart won't let you call it is a retreat. The money is not leaving AI. It is leaving one aisle of AI. And the plumbing is where this story reaches your house. Data center electricity demand is forecast to grow about 26% this year alone, from 104 gigawatts to 132. By 2030, nearly 290. The requests are already staggering. In 2025, data centers asked U.S. utilities for 700 gigawatts of new grid connections, more than the entire country draws on an average day. Somebody has to build those power plants and those lines, and utilities recover the cost from everyone on the grid, not just the data centers. It has already started. PJM, America's largest grid operator, projects about $6.3 billion of added consumer electricity costs over the next 3 years, mostly attributed to data center demand. So here is the quiet punchline of the rotation. The market spent 3 years arguing about silicon, and the binding constraint moved to electricity. The chip is no longer the scarcest thing in AI. The socket is. And unlike chip stocks, the socket sends you a bill every month. Now the part every rotation story owes you. The catch. The same Wells Fargo report that found the all-time low correlation asked the only question that matters next. What if the returns never show up? $725 billion a year eventually has to earn its keep, and the market now demands receipts, AI revenue, not AI promises. If returns disappoint, the capex gets cut, and when the check writers cut, the check receivers fall together. Chips, builders, utilities, the whole receiving line. But notice, this test has already run once. The late July earnings came in, all 4 big spenders reported, and instead of cutting, they raised their plans. That is where the $725 billion on tonight's chart comes from. The market read those same reports and sold chip stocks anyway. That is not a verdict on AI. That is a changed mind about who wins it. The next reading arrives with the October reports. Capex guidance, updated every quarter. The quarter those numbers stop growing, the rotation story flips, and we will say so. Until then, the $1 trillion is still flowing. Just not where the crash headlines told you to look. The lessons, bigger than this month. A rotation and a crash look identical on a red screen. The difference is where the money lands next, so always ask where it landed. The professionals move on notes, headlines move on pain. The gap this time was 3 weeks, and it usually exists. Follow the whole dollar, not the famous 60 cents, 40 cents of the AI build-out never buys a chip. Bottlenecks migrate. Yesterday the constraint was silicon. Today it is electricity, and constraint is where pricing power lives. And one number arbitrates the whole story. Quarterly capex guidance. When the checks shrink, everything downstream shrinks with them. The whole story, in 30 seconds. In July, chip stocks lost more than $1 trillion, while the 4 biggest chip buyers raised their spending plans to $725 billion for next year. Both true. Because the AI trade rotated, it didn't die. The proof is the divorce. Correlation between chips and their customers fell from plus 0.78 to minus 31%, an all-time low. 40 cents of every capex dollar never buys a chip. It buys buildings, cooling, wires, and power, and the grid is now the bottleneck, with $6.3 billion already headed for consumer electricity bills. And the number that settles what happens next lands in October. Capex guidance. Watch the checks, not the headlines. If tonight made you want more mechanisms behind the headlines, how a 5-year-old firmware bug, and zero quantum computers, emptied Bitcoin's safest wallets, that is our latest episode, on screen now. Next to it, who really sets interest rates, because the answer isn't the Fed. And to be clear one last time, nothing tonight was investment advice. We measure how the machine works. What you do with it is yours. If this stopped you from selling a rotation priced as a crash, or buying a headline without reading the note underneath it, subscribe. Technology and money, mechanisms before narratives. And when October's capex guidance lands, we'll be here to measure it.